Hello, everyone, and welcome. It's my great pleasure to introduce Izet Elmazi. We were recently in a conference in Winnipeg and heard Izet speak about the dividend growth pool with value partners. And we thought, what a great opportunity for him to share his investment discipline directly. So also with us today is John Van Limbeek, my business partner, and Taylor Bertoli, one of our associates. A few years back, we had an introduction to Bristol Gate, which it's been an absolute pleasure dealing with Bristol Gate and their investment discipline over the last few years. Izet has been doing a great job of communications with value partners, our clients, and he's spoken at just about every value partners conference we've been at. And we're intrigued with the entire process. So Izet, thank you very much for taking your time to join us today.
Thanks for having me, Mark. It's always a pleasure speaking with you.
Yeah, we sure enjoyed your talk on Wednesday, and we've developed some questions based on that talk, so that you can share this directly with our clients. So I guess I'll start, Izet. Our mission statement says we improve lives. So for us, it's very important for our clients to understand, what we do, the decisions we make. And we always tell them, if we're doing our job, you don't have to worry. And you can go home, put your head on your pillow, enjoy your retirement, or not worry about the growth of your investments over time. So today I thought, we're going to ask 3 questions of you today and maybe get you to explain your process so that, when they see dividend growth on their portfolios, they have a lot of confidence. I know, to speak personally, the dividend growth pool is one of my larger positions. And we also have an investment pool for our employees here, and the dividend growth pool is part of that. So today we're going to learn a little bit about your history and so on, and why we believe so much in that. So under the guise of we improve lives, our clients need to have confidence in our process, in what we're doing, and understand that. So could you, Izet, maybe give us an idea of what your process is and how you come to own the companies that you own, a little bit about your history and how that's played out over time, and then your belief in owning the companies that are growing their dividends the most looking forward over the next 12 months. So I'll hand it over to you, and if you could give us a little bit of insight, I'm sure our clients would be very appreciative.
Perfect. Thank you. And thank you for the kind words. It means a lot to us that you're invested personally. It's included in part of your employee pool. And, just like you, we are also invested in the strategy ourselves here at Bristol Gate. And so, this isn't a job for us. It's our wealth being created and participating alongside yours as well. So I thank you for your support. Yeah, our firm started back in 2009. And really, it was a simple idea that kicked off our investment thesis, which is the value of an asset and the income that it produces are inherently linked over time. If you think about real estate as an example, the value of a building is directly related to the rents that it produces. And so if we can find these companies that are growing their dividends over time, theoretically, we should also participate in the capital appreciation of those companies over time. And so that's what we try to do. We search for these high quality companies that can grow their dividends year in and year out at rates well above the market average. Now, dividend growth investing is a pretty popular strategy, but I think we had 2 unique insights from our founders at the very beginning of our firm that set us up for differentiation. The first unique insight was they asked a simple question. They said, what within dividend growth does better than dividend growth? And that led them to this high quality, high dividend grower cohort that we think a lot of the market and our peers are actually underappreciating. The second thing that they did, which was interesting, was that they realized through their research that if they could figure out who next year's dividend growers would be, that further improved their odds of generating attractive returns. And so they took a forward view to the market as opposed to the backward view that most of our peers take. And we developed a dividend growth prediction model right from the beginning of our strategy. Initially, let me just get this up on my screen here.
It really intrigued me, your process, when we were first introduced to that. That's for sure.
Yeah, it's something that's very different than a lot of our peers, as I said, because we do take this forward look. And initially, our dividend growth prediction model was a simple linear regression where a couple of factors were input into Excel and a dividend growth prediction was output. But since then, as the tools have become available, as we've been able to hire the right people with the skills to develop these things, we've been using a machine learning model since 2017 that helps us predict dividend growth for the entire S&P 500 universe.
Wow.
And what our model does, in addition to allowing us to process a lot of information relatively efficiently, is that it removes any bias that we may have on certain companies and certain names. So, for example, it doesn't care that I think that Microsoft is a great company. It lets the numbers do the talking, and it produces a prediction strictly based on the inputs that we feed it. And so that bias helps us make better decisions. The removal of that bias helps us make better decisions. And then the second thing that it does is it actually improves our accuracy. Our model does a better job of predicting dividends than the various benchmarks that we compare it to. And that includes, Wall Street analysts. We compare our error rate to theirs, and we've consistently had a 50% lower error rate in terms of producing or correctly predicting dividends.
So then once you've got to that model, you hand it off to your analysts and your CFAs, and at that point it gets the human touch?
Absolutely. So there's various human touches throughout this. One is building the model itself. That does require the human touch. The model makes the decisions on what's important in predicting dividend growth, but the model does not build the portfolio. It's just the start of our process. And I think that's important as well, because as great as technology is, our chief data scientist always likes to say, I'm not ready just yet to hand the keys over to a Tesla and let it take me everywhere I need to go, even with the autopilot, right? At some points, you hit turbulence, and you need the human experience, the human capabilities to take over for those situations that are unique in some sense. And so the model is the starting point of our process. It produces a high potential focus list for us then to take and go do the fundamental work, go understand these companies, who they're competing against, how they compete against them, what are the revenue growth drivers in the industry, et cetera. All the stuff that, you would typically do as a CFA fundamental analyst. And our goal then is to build, we call that fundamental process productive capital analysis. It's all about figuring out how these companies generate cash and then how they go about using that cash. Because we want companies that can grow their dividends on the back of good old-fashioned fundamentals. Rising revenue, rising margins produces more free cash flow, which ultimately leads to more dividend growth. And so that's our goal. Our goal is to build a 22 stock portfolio that's not only concentrated, but diversified across the risks that we identify through our work.
It's interesting. A lot of clients will ask us, how do you know which sector to go into? And I guess, if there's a sector that's really performing well, it's going to show up as one of the companies that may do best in the next 12 to 24 months in dividend growth. So it naturally follows different and switches between sectors, I would imagine.
Yeah. So we always like to say that we're sector and style agnostic. We do not have a view on any particular sector at any point in time. we follow the dividend growth, and historically our model has done a great job of identifying where that dividend growth will be. And so, some people like to put you in a style bucket as a growth guy or as a value guy or as, this or that. And all we'd like to say is that we will go to wherever the dividend growth is. And because ultimately we know that if we can find those growing income streams, it tends to lead to good outcomes for our investors.
One of the things, and it was part of the original question, but your history of the earnings and dividend growth of your companies, a trailing look at that versus the S&P 500. I've always thought that was very impressive what you guys have accomplished in the past.
Yeah, thank you. We've grown our dividend. Our portfolio companies have grown their dividend at over 19% a year on average. And that is well above the market rate. And it's well above a lot of other income streams that you can get through various other investment vehicles. And so we're very proud of that. And that's something that we think that if we can continue doing that, if we can continue finding these great investment companies, these great companies that are of high quality, that have durable growth opportunities, that generate a lot of free cash flow, and they have these management teams that think and act like owners, that they can produce this type of dividend growth that ultimately works out well for our investors.
Fantastic. Taylor, I'll get you to ask the second question.
Yeah, so our second question is, how have the results of the process that you just spoke about been with Bristol Gate over the long term? And can you comment on the dividend and earnings growth in the last year?
Good one.
Yeah, absolutely. So the last year was challenging from a return perspective for not only ourselves, but also the market. And sometimes that happens in the market. There is not always going to be a direct correlation between the underlying fundamentals of your portfolio companies and the price return at any given point in time. But over time, there should be. Over time, fundamentals matter. There's that famous quote by the father of value investing, Benjamin Graham. In the short term, the market's a voting machine. In the long term, it's a weighing machine. And the weight of that earnings ultimately matters. And so when we look at our portfolio from a fundamental perspective, it continues to perform extremely well. Last quarter, during that reporting period, our holdings delivered approximately 7% revenue growth year over year and almost 14% earnings growth year over year. And that compared to the market, which delivered just under 5% revenue growth, but EPS actually declined 4% year over year. So there's a huge delta there on the earnings side. And this isn't just a one quarter phenomenon for our companies. When we look back historically, you can see on the slide that I have up here right now that consistently over the last 3, 5, and 10 years, our portfolio companies have produced fundamental results that have far outpaced the average constituent in the market. And so whether it be revenue growth or EPS growth or their free cash flow margins, which have historically been more than 2 times that of the market, our companies have done well from a fundamental perspective.
The beauty of the discipline, Izet, is, and our good friend Greg Philman says this all the time, when the fundamentals of the business are outperforming and nothing happens with the stock price, Greg calls it compressing the spring.
Right.
We know that the spring is going to come back to normal. It's just a matter of when. And
I think last year was a great indication of that, right? Because fundamentally, our companies kept on building up that pressure of the fundamentals. It kept growing and growing. And valuations were taken down across the board indiscriminately last year. And there was a lot of multiple compression. So when the fundamentals are going up and the multiples come down, there's really only one way for that multiple to go. So
that's right. That's right. You also, I believe in Winnipeg, talked about the long-term rates of return versus different indexes. I remember seeing a slide about that. Yeah, that's the one.
Yeah. Yeah. Oh, you know, we think that our process is sound. That idea of rising incomes leading to rising value to us just makes sense. It's a fundamental investment tenet, right? And so if we can continue finding these types of companies over time, we think that our strategy has an ability to provide very competitive returns. And when we look at our returns since inception, it's done just that. You know, not only have we done better than the S&P 500, but we've done better than the dividend growth universe within it. And I think that that speaks to the value that our process helps create and uncover.
Right on. John, I'll just ask you to ask the last question, please.
You bet. Is that in times of uncertainty, there's always is, like, how does your process, or how do you believe your process fits to create certainty, improve the lives of our clients, and have that, you know, bring that peace of mind, I guess?
Yeah, I think peace of mind comes from the knowledge that, you know, we've thought about a lot of the risks, the various risks that can impair your wealth objectives, and have tried to embed risk mitigation throughout our investment process. So, for example, only focusing on companies with a multi-year dividend history helps us avoid the high momentum, high expectation stocks that, you know, we believe most of the risk of overpaying for growth resides. A commitment of a growing dividend by these management teams instills a degree of capital allocation discipline within them. We think that inherently reduces risk. You know, we have this concept of a dividend growth hurdle that helps us exit positions long before they mature, and helps us avoid some of the problems that come when growth falls short of expectations. And you know, we even quarterly rebalance to trim stocks that have done really well and reallocate to our laggers. And that inherently contrarian mechanism helps reduce valuation risk within the portfolio, right? Because we're trimming the stuff that's done well in a short period of time. So all those things I think help us give you peace of mind, and it certainly gives me peace of mind with respect to our process. Ultimately, though, you know, we help improve lives by assisting our investors in achieving their financial goals through delivering a rising income stream and the capital appreciation that comes along with that. And so I've heard Mark say before, you know, he wants his clients to wake up every morning and say, we're making money today. Well, with our dividend growth strategy, not only are you making money today with the dividends that you're going to receive, but you can expect that dividend income to grow in the coming year. It's like giving yourself a raise. And that matters, especially during times like this when our purchasing power is being degraded daily by inflation. And I think the best way to actually show how our strategy improves lives through the market volatility is through this chart, which shows the stock that we've held longest in our portfolio, United Health Networks. You know, United Health Networks is a healthcare insurance provider in the US that we acquired in 2014. Since our initial purchase, you can see that the dividend is up 5x over that time, and the stock is up over 6x. And so there you see that inherent link between the income an asset produces and its value over time. But what I think is really interesting here is, you know, if we were to focus solely on the price, that roller coaster rides of the daily ups and downs might have shaken us out of this name several times over the years. There's some decent sized declines through those periods. But we were focused on the fundamentals, and we were focused on the step change function of those dividends. And by focusing on that, it helps us avoid some of that noise, and again, gives us the peace of mind to stick with these names through the turbulence and ultimately deliver the results that we have for our investors.
Fantastic. Well, I think we're gonna wrap it up, Izet, and I have to personally thank you. I know that my thought process about, you know, your investment process on how you take care of our clients, I have peace of mind, complete peace of mind. We've been adopters of the dividend growth pool since day one when you joined Value Partners. It also, like a lot of other pools in Value Partners, your dollars are invested right alongside ours and our clients. I know during the initial stages of COVID, I had a conversation with one of our other managers, and I asked him how his mom's investments were, and she said they're doing fine because they're right beside yours and mine and everyone in Value Partners. So that gives us great peace. I've enjoyed your communication over the period with Value Partners, and I look forward to a great future working with you and you helping our clients have peace of mind and grow their wealth and protecting it over time. So thank you very much for your time today. I can't say enough to thank you.
Well, thank you for your support. We appreciate it, and we'll continue to do our best to not only serve you and your clients, but also ourselves as investors in the firm too. So thank you.
I like to hear that.
Yeah.
We'll see you, everyone.
Thanks, Izet. Thanks, everyone.
Bye.